And this week's market update. A busy week for US data, plenty to absorb on this side of the pond too, oil at $75 and some high-profile earnings reports. The US is the main market focus this week, with key data announcements on most days. Put together, they should provide a clearer picture of the outlook for the world's biggest economy. The news started to flow at the end of last week, actually, with evidence that private sector pay in the US is now growing at its fastest rate since the economic recovery began 9 years ago. The 2.9% rise in salaries in the first 3 months of the year was the fastest since 2008. The wages data accompanied GDP figures, which showed growth of 2.3%, slower than in the final quarter of 2017, although above the trend rate and generally seen as a strong showing in the traditionally weak first 3 months of the year. Wage growth is a key component of the broader prices picture, which was yesterday's focus. As a widely watched measure, the core personal consumption expenditures price index, the PCE, rose from 1.6% to 1.9% in March. With the outlook for price rises to settle at around that level, the government's target level in the US is 2%, as it is over here, the Fed is now expected to press ahead with its planned steady pace of interest rate hikes. The two-day meeting of the Fed's rate setters this week concludes on Wednesday. Although there's little chance of a rate hike this time, so soon after March's quarter-point rise, the odds are improving on another increase in June and for 4 quarter-point hikes to be pushed through in 2018. That's a slightly faster rate of tightening than previously anticipated. Although growth and inflation are not immediate concerns, the Fed has one eye on the likely boost to the economy from the $1.5 trillion tax-cutting package, plus higher expected public spending. With unemployment hovering just above 4%, close to the accepted definition of full employment in America, the potential for a wage price spiral can't be dismissed, and the Fed will be conscious of not falling behind the curve. The final piece in the US economic jigsaw this week will be non-farm payroll data on Friday. The expectation is that job growth would have picked up from last month's disappointing 103,000 to maybe 200,000. Unemployment could even dip to 4%, while average hourly earnings will hold steady at around 2.7%. On the corporate front in America, tech remains the key focus, with earnings announcements scheduled for Apple and Tesla. Apple shares have come under pressure in the run-up to this week's figures, as key suppliers in Asia have warned that smartphone sales are flagging. The fear is that the expensive iPhone X has not been the big success that investors hoped for, buyers unwilling to fork out $1,000 to own the latest device. Countering that weak trading news, however, is the prospect that Apple could start to repatriate some of its $160 billion overseas cash pile under new tax rules. That's most likely to be delivered via either share buybacks or a higher dividend, both of which would of course please investors. Tesla, meanwhile, is expected to report a first quarter loss after production glitches with its Model 3 Saloon. Investors will want to know if cash outflows at the electric car maker will need to be plugged with some kind of capital raising. Also in focus on the earnings front this week will be the pharmaceutical sector. There are results due from Botox maker Allergan, where a smaller loss is expected. Pfizer will update on a potential sale of its consumer health arm. Merck will announce results that investors hope will reflect a recent positive string of trial data. Earnings are very much in the spotlight at the moment as investors look for reassurance that profits can rise quickly enough to justify the high valuations at which US stocks trade on average. The market volatility since early February has intensified concerns about where we are in the market cycle, with pessimists wondering whether the 9-year bull run is running out of steam. So far, results have emerged around 20% higher on average, in line with optimistic expectations ahead of results season, and probably just about enough to keep share prices on the boil. Other threats to share prices include the oil price and bond yields, both of which look like providing equity investors with headwinds at current levels. Oil has gone a long way to reversing the losses it suffered between 2014 and 2016, when the price of crude tumbled from over $100 a barrel to a low of under $30. At nearly $75 a barrel, oil is riding a wave of positives that some believe could see the cost of crude rise back towards three figures. The first of these is simply supply and demand, with the inventories that built up during that 2014-16 glut being worked off thanks to a combination of sharply higher oil demand and production cuts by OPEC and Russia. There's no current sign that the big oil producers have any appetite for restoring supply, with Saudi Arabia keen to keep the price high ahead of the flotation of the state oil producer Aramco next year. The next key driver of a rising oil price is political instability, with Donald Trump's threat to reimpose sanctions on Iran a major risk. Falling oil output in Venezuela is another factor, as are the proxy wars between Saudi Arabia and Iran in Yemen and Syria. The downward pressure in the oil equation continues to be provided by US shale, with output expected to rise by 10% this year. So far, the extra production has been absorbed by higher demand, and there are limits in terms of infrastructure to how much unconventional oil can be produced and brought to market. For now at least, oil looks like remaining well above $70. As for bond yields, the rise last week of the US 10-year Treasury yield above 3% for the first time since 2014 has spooked investors. The fear is that having broken this psychologically important hurdle, rising inflation fears could see bond yields rise to 3.5% or beyond. If this were to happen, the equivalent income from shares would start to pale, and the only way to regain a sensible balance would be for share prices to fall. That pushes dividend yields higher, of course. Higher bond yields also imply a higher cost of borrowing for companies, reducing profits and in turn share prices. While further rises in bond yields are possible, there's a strong argument also that 3% could represent a short-term peak. Certainly, it looks as if big buyers of US Treasuries, like the Japanese, are attracted by this level of income. So to assume that bond yields go much higher, you also have to think that interest rates rise significantly from here too, and that seems less likely on a sustainable basis. At some point, the economic cycle will roll over and the Fed will cut rates again and maybe reintroduce some form of QE. Bond yields may not be too far wrong at their current level. Meanwhile, on this side of the pond, there's plenty to keep an eye on too, and little of the news emerging in the UK is particularly encouraging this week. First, on Friday, we had a much worse GDP number than anyone expected, with growth of 0.1% in the first quarter. That's well below expectations of 0.3%, and that itself was a fall from the previous quarter. The year-on-year growth rate for the UK economy is now just 1.2%, and that's the lowest since 2013. Already, the 1.5% consensus forecast for 2018 looks ambitious. So, what has caused the major slowdown in the domestic economy? Well, a combination of slowing global growth, Brexit and the weather look like being the main culprits, although the worse performance here than elsewhere in snow-afflicted Europe does seem to point the finger in particular at Brexit's impact on consumer and business confidence. The slowdown raises doubts about whether the Bank of England will feel confident about raising interest rates next week, when only a few weeks ago a further hike to 0.75% seemed a certainty. This is potentially really important because it suggests that Britain may be unable to follow the US back towards relative monetary policy normality. This could pose real difficulties as and when the economy next needs stimulating. The bank just doesn't have any firepower, with rates still at what we used to call emergency levels. Now, emergency may be slightly too strong a word to describe the UK government at the moment, but with Home Secretary Amber Rudd resigning at the weekend over the widely condemned treatment of long-standing immigrants to the UK, it's not a huge exaggeration. With the policy of creating a hostile environment for migrants to Britain having been implemented during Prime Minister Theresa May's time at the Home Office, it's unclear where this latest crisis will end. The first test will be local council elections on Thursday, at which the governing Conservatives are expected to have a tough day of it. The big story of the week in Britain on the corporate front is related to the economic woes facing the country. The proposed merger of Sainsburys and Walmart-owned Asda will, if it's allowed to proceed, create the UK's biggest grocery chain, exceeding even mighty Tesco's 27% market share. It's a reflection, of course, of a broader retail malaise. A competition authority investigation looks to be a certainty, but having given the nod to Tesco's recent purchase of Booker, and with the growth of German discounters Aldi and Lidl in the UK market, it's not impossible that the deal will get the green light. The logic for the deal is clear, and the 20% rise in Sainsbury's share price on Monday morning provides a guide to the cost-cutting and supplier squeezing potential of the merger. Whether consumers would benefit from 60% of the UK's food market being in two companies' hands remains to be seen.